This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
A very good morning and warm welcome to Money Sense. Your hosts this morning are Neville Hicks and myself, Simon Caudry. We're delighted to be joined in the studio this morning by Grant Williams. Grant is the co-founder of Real Vision and the author of Things That Make You Go, a weekly financial newsletter read by the titans of the hedge fund industry. Grant, thank you very much for joining us this morning. And what is your second appearance on the show?
Yeah, thanks for having me back, Simon.
Good morning, guys.
Absolute pleasure. So, Grant, I've read your most recent newsletter that you've produced, and one of the topics that you focused in there was the pension time bomb that you think is existing. Do you want to talk to us a little bit about that? Because when people think about pensions in this community, and we'll talk a little bit about the Cayman pension system later, when they think about pensions in our community here, we all have these defined contribution pension schemes, and therefore the idea of there being a pension time bomb perhaps isn't quite as relevant. So what do you mean by that phrase?
Well, I've been looking specifically at the US and UK, and if you look over there and see the level of underfunding that a lot of these pension funds have, pensions are something, it's such a long way off in the future, people don't think about them in current terms. They're easy to kick the can mentally down the road, and that's what's been happening. But you go through all the states, and all 50 states are underfunded, some of them to the tune of 1% or 2%. But there are several states, Illinois, New Jersey, that are underfunded to the tune of 50-60%. And these are massive levels of underfunding.
So what do you mean by underfunding? Just to clarify that for us.
The investments haven't been compounding at the forecast rate. The forecast rates have generally been in the 8% area. Some of them have lowered them to 7.5%. And CalPERS, the California State Pension Fund, which is the third or fourth biggest in the world, I think, recently lowered theirs to 7 and talked about 5 or 10 years of challenging returns in the industry. So this, because of compounding, is not a problem that's just going to go away on its own.
So let's just put that into some context. There may be people who are listening to this show who work for government, and the government itself here has what's called a defined benefit pension scheme. That means that they promise you a fixed amount of money when you retire in order to live on. You're saying that most pension schemes in the US, for instance, they're forecasting a rate of return of around about 8%. And what happens if they don't meet that rate of return then?
Well, because of the beauty of compounding, every year you underperform that run rate, the deficit grows larger. And we've had 15 years now where the S&P 500, for example, has compounded at a rate of about 3.7%, which clearly, with a 60-40 portfolio, is going to leave a big hole. And that hole is only going to get worse. So these are problems that, absent some material growth, absent stock markets performing way, way better, these are problems that are going to have to be faced at some point. Not just yet, but the day when they will have to be faced is getting closer.
And when you say that the problem is something that's going to have to be faced, when you think about the mix, you've got bonds and you've got equities. Bonds are currently yielding maybe 1%, maybe 2%. So you've got 40% of your portfolio only with the potential to get 2%, and you've got 60% that in order to average overall at 8 has to earn double-digit returns. That's kind of the problem you're talking about, I guess.
Yeah, exactly. And what's kept this going for a little bit longer than it should have done normally is the capital gains that people have made on their bond portfolio. As we've seen the governments buying bonds, we've seen people moving into all kinds of weird and wonderful areas in the bond market to get more yield. They've had capital gains, and that's covered up this lack of interest income from the bonds, lack of coupon income, and that's now reaching a point at zero interest rates where that game can't actually go on much longer.
Well, why is this a problem then? Most people don't retire for 30 years. Things could change, or 20 years, whatever it might be. Things will change. Why is it a problem for us to worry about today?
Well, it's something that to your point, these things do tend to, over the life cycle, average themselves out. If you look back, historical 10-year returns, there's a reason these guys all look at 8% compounding. Over time, that's what's happened. We happen to have been in a period of 15 years now where we've had this massive underperformance by the equity component in these portfolios. And now, suddenly, the underfunding levels that causes are enormous. And if you throw in the fact that the baby boomers are now starting to retire, so a lot of these promises are starting to come due, you're at the problem where previously this has been a problem for another day because we haven't had the big payouts due. Right. Now people are starting to retire, and so you're starting to have to pay out of these schemes, which just lowers the amount in the kitty.
And that's a problem because ultimately governments could run out of money? What's the actual implication we're talking about here?
Well, governments can't run out of money, as we've seen in recent years. They can just print more.
Sure.
But we do end up with this problem where these are promises made to government employees by governments. Essentially, they will have to be made whole at some point. Otherwise, people are going to be told you're going to have to expect less. Neither of which is popular, particularly in an election year in the US, particularly. So at some point, there's going to be a hole that needs filling. It's likely to come from the government balance sheet because there's nowhere else to really take that money from. Then we get into this problem of debasing currency, inflation. We get into a lot of problems with printing more money to fill another hole.
Okay, so
sorry, I was going to just touching a little bit more on even CalPERS and some of these pension funds coming in now and saying, realistically we expect to earn or whatever the discount rate is 7% or even 5 to 7 real rate sounds ambitious given where we are with equity valuations and then current yields. We're coming off of a 30-year bond bull market. I mean, do you think that's realistic, or are they just going, we're going to throw a Band-Aid on this as far as what we think, even though their even revised targets are probably unrealistic?
Well, the revised targets haven't been met in 15 years. So
what's
realistic. Well, because look, if you lower your expectations from 8 to 4, that creates a world of pain. If you lower it from 8 to 7.5 and then to 7, that's happened in a few places quietly. Now you get someone like CalPERS coming out, and not just the lowering down to 7, but the talk about 5 to 10 years of challenging environments. That's their way of saying, we're not done with this. We're probably going to have to lower these things again. And it doesn't take long, because of the beauty of compounding, it works in the other direction as well. And when you're underfunding and that compounds, the gap just gets bigger and bigger and bigger. So it's going to have to be faced, but it's a very big problem with multiple billions of dollars at stake that no one's going to face willingly in one go. They're going to have to try and ease their way into this.
So if we take that story and we say, okay, let's bring that back to what it means for somewhere like Cayman. Before we planned this show, I did a little bit of research about the Cayman government pension scheme, which, as I said to you, is one of those schemes which is a defined benefit scheme.
And is that's the correct me if I'm wrong, is that the only defined benefit scheme in Cayman?
Well, for government, judicial, and those sorts of parties, yeah, exactly. Right. All those people who are working in the private sector have what are called defined contribution, which means you put your money in each month. If it goes up, that's great. Your pension pot is going to be bigger. If it doesn't go up, your pension pot is going to be what it is. What you see is what you get.
Yeah, and your employer matches.
Exactly. So that's kind of like what you see is what you get. Whereas the defined benefit is what you see is hope. What you is. What
well, the payout is defined by the very nature.
So when you look at the government numbers, they've got so just by way of context, the government, and this is from the latest audited statements of the government, they have around $600 million here in Cayman in debt. So that's a pool of debt that they have. They have a current deficit on their 2014 audited statements of about $165 million. So anyone who has a pension or is going to be relying on a pension from the Cayman government, currently they're missing, if you like, $165 million from the pool in order to make good on their pension promises. That's kind of the way to understand it.
Yeah, but the one thing I would say, though, the number's much smaller than that at the moment, because obviously that's to fund everybody in the pension plan. A lot of them are in their 20s, 30s. They won't be retiring for some considerable time. And that's why these things can go on for a while, because you can still pay out the people who are coming due. It's just when that gap gets too big to meet the needs of the people coming.
But you mentioned that is based on discount rates or expected returns, which are unrealistic. And you mentioned that 8% is an unrealistic number. Well, funnily enough, the Cayman government's expected rate of return is 8%. So in actual fact, if we're saying it's a lot less, the realistic rate of return in the future is a lot less, that number of the deficit, 165 million, could well be 2, perhaps 3 times the size. Is that kind of the order of magnitude that we should be assessing?
Well, I've spoken to actuaries about this, and they tend to all believe the same thing. They revert to this idea that over time, over 9 or 10 year periods, that these things, you get periods of underperformance and periods of outperformance. And there's plenty of empirical evidence to suggest that 8% was a sensible benchmark, a sensible run rate. But things have changed. Since 2000, and particularly since 2008, things have materially changed. And those run rates haven't changed to reflect that, mainly because to do so would create all kinds of ripples through that system in terms of widening the underfunding levels to extraordinary levels overnight. So this is something that has to be dealt with softly, and at some point there will be a period in time where there are more people who are starting to take out than are paying in, and that's when you really have to make serious decisions. We're not quite there yet, but with the boomer generation starting to retire in their droves, as I say, that day is moving forwards much faster now.
And it behoves governments, presumably, to take action. The earlier you take action, the more you can get in terms of contributions you may put in, the greater the compounding effect of those contributions as well.
Yeah, absolutely.
And I guess the reason I bring this up is simply that there are two choices, aren't there? One is people who are on a government pension, if the deficit is not cleared, are going to see a lower pension than they expect. Or the government's going to have to raise new money through borrowing or taxes in order to be able to pay those obligations it expects. So either people are going to be paying tax in Cayman in some shape or form, or expect lower pensions, is ultimately at the end of the, if those numbers are true.
Yeah, if it continues that way, for sure. I mean, so there are ways that this can work itself out, but we've seen a 15-year period now that has made those ways very, very difficult to catch up now.
So one of the ways that people, I guess, governments rather, can solve these sorts of problems is by, if you like, printing money, creating money out of nothing. And it often confuses people when you hear this expression, printing money. What does it mean, and why is it a problem? You think, well, the government goes and prints some money, goes and prints $100 million and goes and spends it. Why is that actually a problem? Why is that something that can't be done? Perhaps we almost need to step back sometimes and just go through the first principles of why that's really a problem in order to be able to address what the implications are.
Well, the problems are, money in circulation is the real problem, assuming you have some velocity, assuming that money is moving around the system. If we had a finite amount of money between the three of us here, and there was one remote control that we could all compete for, there's a finite price for that thing. It's the total of all our money. If we inject more money into the system, if I get an extra $50 that I just print, then obviously I can outbid the two of you, and the prices tend to move up. And when people fear that prices are going to rise, they tend to want to spend their money faster, and you get these periods of inflation. So printing money, it's managed to carry on for a number of years in the West, largely because the velocity of that money, people haven't been changing it, they've been storing it, they've been saving it, so it hasn't made it out into the marketplace and pushed prices up. But if you start to get people worrying that that's the answer to all the problems, print more money, they will start to spend that money more quickly. They will start to try and get out of their savings.
You're saying then that printing money creates inflation risks, and absent controlled inflation, you can have serious problems.
Absolutely, yeah.
And so the serious problem, what would an extreme example of a serious problem look like? What should we think about? Because people who are alive today haven't probably lived through, most people haven't lived through a period of extreme inflation. The last one in the Western world was probably, the 70s, frankly.
Yeah, for sure. I mean, look, these periods happen throughout history. The most recent one was actually in 2008 in Zimbabwe, where inflation topped out at 231 million% a year. I mean, it sounds ludicrous, but you go in to have a meal and you paid for it up front because the price would double by the end of the meal. I mean, it was literally that crazy. And this was purely the government printing money and people just wanting to get rid of it as fast as they could. It was 100 billion Zimbabwe dollars for 3 eggs.
But are you suggesting, though, that the Federal Reserve and the US government, by printing the money it has, is in effect creating the risks of something like that happening?
It's a very in somewhere like the United States with the assets it has, it's a very small risk. But certainly what we've seen was a lot of expected inflation when they started to print money, and that hasn't happened. But if you look at the reason for that, is because that velocity of money has fallen to all-time historical lows, so that the money just isn't changing hands. You've got people whose personal balance sheets were severely damaged in 2008, who instead of spending money and trying to generate this 2% inflation, which is what the Fed's trying to do, are saving because their balance sheets have been destroyed. And personally, they lost a lot of money in 2008, so they're not inclined to go out and spend.
So the average, when I hear the word, there's being more saving, I sort of intuitively think to myself, well, that's a good thing, isn't it? On average, when people save money, that creates greater opportunities to invest money for future projects, and it creates future wealth, and it creates more productivity or improved productivity of capital and labour. Why, therefore, is the idea that money is being printed and saved bad for the economy? So explain that one.
Because the idea of printing the money was to generate inflation, and this time just 2% inflation. When you have the debt load, that we get back to compounding again, when you have the debt load that somewhere like the United States has $19.5 trillion in debt, you need inflation, because if you have deflation, obviously the amount of that money you have to pay back gets bigger. And once again, we get into that negative compounding problem where the less you have and the lower interest rates are, the more you have to pay back. So 2% inflation is something that helps pay off that debt in devalued 2% a year dollars. So when you start to do these things and people, instead of going out and bidding up goods and services and creating that 2% inflation, which is a magic number, you'd have to ask a central banker why they picked 2%, you end up stuck in the spiral, and you keep pushing on it, and at some point, the more you do that, if you lose confidence, and this is all really about confidence now, if you lose confidence in what the central bank is doing, then people suddenly do want to get their money out. They don't want paper money that's going to be printed. They start buying houses, they start buying real estate, they start buying gold bars, they start buying assets that the government can't devalue by printing out of thin air. So it's a very fine line to walk, and thus far, optically, it's worked out okay. We haven't seen any hyperinflation, we haven't seen really any inflation of any kind at all. But you're always, every time you add another attempt to do this, you run in the risk of running into problems.
Go ahead. Look, we're going to take a short break, and then after the break, in a couple of minutes, we're going to assess what the implications are in terms of market implications, what that could mean for stocks, bonds, and such like, and also talk a little bit about other topics of interest of today, and one in particular being the upcoming US presidential election and what that might mean for markets. So join us again in 2 minutes after the break.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back. In the second half of today's show, we're going to continue our conversation with Grant Williams about the markets and the implication of the pension time bomb, and also we're going to address the upcoming US presidential election and what it might mean for markets. Grant, thank you again for joining us. And in the first half of the show, we ended it with an analysis of the risks of creating inflation, what happens if you print too much money that inflation's created. As an investor, people are listening to this and they're saying, okay, I listen to what you say and I worry about what you say. If this comes to pass, what do I need to be worried? What do I need to be most worried about?
It's a very, very challenging environment. I mean, I've been doing this for 30 odd years. I've never known an environment this challenging. And so it's very hard. I mean, right now, ironically, the thing that central banks are trying to push you out of is cash. That's what nobody wants you to hold because they need this velocity higher, as we were talking about in the first half of the show. To me, that tells me that there is a great deal of value in holding some cash. Yes, you're not going to make any return. Interest rates and the deposit rates are very, very low. But the optionality that having some cash right now affords you, if there is a correction, we've got US equity markets at all-time highs. So the risk-reward of being long here, might they go up another 5-10%? Possibly. Could they fall 15-20%? Absolutely they could. So to me, the value in holding some cash right now makes sense. I think US Treasuries are still, amazingly, a sensible thing to own and hold. But people need to be just aware of this. This is not panic. We're just saying, if you look at the probabilities, the risk-reward payoffs of being long of equity markets at all-time highs in an environment such as we're seeing without any real growth, it's just a dangerous place to be, and people just need to be cognizant of that.
Well, when you talk about holding cash, though, if there is an inflationary circumstance in the economy, isn't that a very dangerous thing to be holding in those certain scenarios?
Yeah, for sure. Look, if we do get an outbreak of inflation, then absolutely holding cash is a poor investment. At that point, you want to own real estate. You want to own physical assets that people will swap that money for. I mean, if money starts to become worthless, people want to exchange it for goods, and that's something you need to be aware of.
So one of the things another thing that central banks are doing right now is putting negative interest rates in front of people, and that's sort of a second solution to this problem that there doesn't seem to be enough inflation, there doesn't seem to be enough growth. But I get confused by negative interest rates because I guess when I was growing up and I was learning my basic economics, the idea was that interest rates go up when things are too good. Interest rates go down when things aren't very good. So if we're in negative interest rate territory, how close are we to Armageddon on that logic?
Well, this is something, it's been tried before in small periods, never like it has been right now. You know, we have $13 trillion of foreign government bonds trading on negative yields, i.e. people are paying governments to borrow from them. And they include countries like Spain, who were one of the pigs a couple of years ago, if you remember that, and had interest rates in the teens. This is just a natural consequence of all these different attempts to try and generate this 2% inflation. Right now, the thinking behind this is if we take rates negative, it will force people to take that cash and spend it because they don't want a guaranteed negative return. But as I said, the damage in 2008 was so severe that people are actually being forced to save more and consume less. And so the fact that they're negative interest rates means they're not going to earn any income on their savings. And so they save more. Instead of spending it, they're being forced to save more. So this is a really nasty spiral to get into. And going back to my point about confidence earlier on, at some point, there comes a time, unless we do get some growth and we do get an organic way out of this spiral, at some point people will lose confidence in the central banks. And that's when you'll see the negative effects start to take place.
I guess, so following on that, what is, we all don't have a crystal ball, but what is, or some of the, actions that either governments or corporations can take to start moving us towards, I guess, what is growth, one, and aiming for inflation, two?
Well, look, we've got interest rates. I mean, it's never been cheaper optically to borrow money, which you would like to think people would borrow and invest and grow. But we're seeing consumers retrench after 2008. People, again, had borrowed an awful lot of money for houses and taken equity out of their homes, done all the things that we've all read about. So unless you get those animal spirits that Keynes talked about, people wanting to go out and borrow and invest, it's very difficult to generate that. And as you can see, the fact that we've reached negative interest rates in an attempt to try and stimulate those animal spirits tells you just how difficult this is going to be. And we're in that position where we don't really have any real growth. US GDP was 1.1% the last quarter. It's tracking at levels that is nowhere near where they need it to. And so something needs to get us out of this cycle. It's likely going to be some sort of debt wipeout, whether it's a Jubilee or it's some agreement that the central banks start to monetize the debt. I don't know. But at the root of this, and we spoke about this last time, Simon, there's just too much debt in the world overhanging, and it can't be paid off.
So I don't know if the cynic in me or the thinking of it a different way, if there's too much debt in the world, also if governments have too much debt, and then governments in effect are imposing negative interest rates, doesn't that reduce their debt burden? Isn't that actually arguably a good thing for governments? If they raise $1 billion in debt, they have a negative interest rate. At the end of it, they only need to pay back $900 million. Suddenly, the government debt burden could theoretically over time erase itself.
Assuming they can sell it all. Right. And again, we're in times of crisis now, essentially since 2008. So at the moment, people are scared enough that they will take a negative return on supposedly safe government bonds. If that carries on, if this isn't just a moment of extreme pressure, people will not want to do that. People will not accept a guaranteed return on a guaranteed loss on their money if it extrapolates out into the indefinite future. If they think, for the next year I'm going to get a negative return, people might take that, as I said, to give them the optionality of a safe haven. But if that looks like it's going to continue indefinitely, that mindset will change quickly.
Speaking of governments buying assets and governments buying their own bonds, you look at Japan, and they've moved even away from bonds into equities. I mean, when does it even? When does the music stop? If the government's
doing the same thing, the UK is doing bonds,
right? Yeah. So, this can seems to have been kicked down the road, and it seems to be continuing to be kicked down. If we look at what's taken place and how far they're willing to go, I guess where do you see that go with, asset prices with equities?
Well, I think the lengths they're prepared to go to, as we've seen, are a great indication of the size of the problem here. And yes, the Japanese government, or the Bank of Japan rather, now owns about 55% of the ETF market in Japan, which bizarrely makes them a top 10 shareholder in 90% of the stocks in the Nikkei 225, which is frightening. The Swiss National Bank owns $60 billion of US stocks, including, I think, $15 billion of Apple stock. So the Swiss National Bank is an Apple shareholder.
Sure.
We get a market correction. Suddenly, the coffers, those 60 billion Swiss francs they've spent on US equities, the market corrects 20%. Well, there's $12 billion less they've got in the balance sheet. So these are real numbers they're playing around with. When does it end? I don't know. But the fear is that this is really, because the numbers don't work, this is not based on any kind of mathematical equation. This is confidence. This is pure and simple confidence. Do people have confidence that what the central banks are doing is working?
Well, that's a perfect segue. The numbers don't matter, and it's all about confidence. Trump. Never a man who's worried about numbers or details. The election is upcoming. It seems to have been upcoming for more months and years than it needs to. I don't know if there's ever a period of time when there isn't an upcoming US election that is the most important one ever. Anyhow, the market looks like, and I say the market looks like, by the very fact that the opinion polls are forecasting that Clinton's going to win and win quite resoundingly at the moment. Therefore, presumably the market is expecting that sort of outcome, and the prices in equities today are reflective of that. What do you think happens to equity markets, bond markets, whatever markets, should the alternative happen? In other words, Trump get elected?
Well, firstly, I would say that people need to get their heads around the fact that Trump has a very good chance of winning this election. I've spent a lot of time in the US recently. It's a very polarized country on left and right. And if you look at what happened with the Brexit vote, which people said was never going to happen, Brexit did win quite resoundingly by 4 percentage points, which is a big win. The stigma in the UK of admitting that you were voting Leave was real. It was a very real factor in the polls completely getting that wrong. In America, the stigma of admitting to being a Trump supporter is of a magnitude far, far greater than Brexit. And so people, when they're asked by pollsters and when they're asked in polite company, it's social suicide to say I'm a Trump supporter. So people don't. So what you're going to see when we get round to them going into a booth with the curtain closed behind them and no one will be able to see them, this is not Democrat, Republican. It wasn't Leave, Remain. This is establishment, anti-establishment. And it's happening all over the world, and it's happening because of the problems we've spoken about earlier in the show. So Trump has a very good chance that a lot of the people who've not only said they're not decided yet are closet Trump supporters, but it's socially acceptable to say I'm voting for Clinton. So people need to understand that this is not the foregone conclusion that the polls suggest it is. I think you need to understand that. Should Trump get in, if Britain voted for Brexit, the markets were going to collapse. It was going to be a disaster. None of that's happened. Markets are very resilient. It will be a shock, I'm sure, if Trump gets in the same way Brexit was. But Trump is not going to be something that tips the world into a meltdown. It's not going to be that. It's just going to be mathematics. It's going to be debt loads. It's going to be a loss of confidence. And maybe Trump's the spark, but he's not the reason for a fall.
I guess one of the overriding topics of the election is the free trade argument, and global economies have done very well out of free trade in aggregate, and yet the average person doesn't seem to have seen the benefits. There's lots of nationalism, populism against it. It's about wars. It's about stopping immigrants coming in. It's about protecting the borders, protecting the domestic industries. How do we get? How does the economics and the finance industry get across a better message as to how and why free trade is beneficial?
It's a very hard thing to do right now because of the increase in inequality that we've seen in the last several years. And people are emotional. And there has been this enormous gap created between the haves and the have-not, the 1%, the 99%. We don't tend to hear that much anymore. But it's very real. And people are angry, hence Brexit, hence Trump. And it's a real problem that's, again, not going to go away without there being some change. And generally speaking, the people who have power don't tend to voluntarily cede it. So we're going to see some upheaval of some sort.
Well, I guess.
Yeah, I was just going to add to that. What's your thoughts on global growth without the trade that we've been having?
Yeah, it's very difficult to see how. Human beings are very smart, very adaptive creatures. But we go through cycles, and this is one of those periods in time where we need to reassess and readjust and work out what the right way forward is. And that's what we're seeing. That's what we're seeing in votes all over the world right now.
Well, this is another one of our uplifting shows to begin the morning with, and everyone presumably now is going to go into the office in a rather more depressed mood than they woke up in the morning. So, Neville, your task in the next 30 seconds or so is to explain why we have the opportunity to learn some more positive things with the upcoming investment forum that's going to be taking place in 4 to 6 weeks. What will people be able to learn at that, which hopefully may reassure them in other ways?
We certainly hope it's more uplifting, but I think Grant raises a number of points, and we the theme is really talking more about what's going on in the world from a geopolitical and ultimately how that filters down to the various asset classes. It's going to be a fantastic investment forum. This is the 4th year. It's on October 13th, and if you're interested at all in hearing, very, very high quality speakers who are down visiting the Cayman Islands, please check out CaymanInvestmentForum.com. you can register there. It's a great afternoon and certainly great value.
And it's a way for people to hear different opinions, different viewpoints, and just learn more about markets and such like, as well as obviously tune into the show. Look, our time is up, gentlemen, and Grant, thank you as always for joining us. It's been a real pleasure. Thank you very much. Now,
Thanks.
as a final note before we leave, just as a typical programming note, just to thank again all our listeners for joining us, and remind you that today's show will be able to be heard as a podcast on our CFA Cayman Islands webpage, and encourage anyone who has a question or topic to email us at moneysense@candw.ky, or send us a tweet, I think that's what it's called, at Moneysense Radio. With that, thank you once again, and tune in 2 weeks' time.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands' #1 choice for online brokerage.